Okay, as you can see in the title of this slide, energy prices were going up even before the Russian invasion of Ukraine because we were coming out of the COVID-19 pandemic and the lockdown measures which were in place in pretty well all the countries of the world. And prices started to rise because of the pressures of a faster return of demand than many people expected would be the case. And on the left-hand side of this pair of charts, you can see that fossil fuel prices in the period, the one-year period up to May of this year, the current month, that fuel prices were rising even before the invasion. And that's across all fuel sources, whether it be natural gas, whether it's coal, or indeed oil. So the price pressures have been there even before the invasion. But over on the right-hand side, as a consequence of the invasion, looking specifically at the prices of crude oil and oil products, you can see that in anticipation of shortages, of potential shortages of crude oil and oil products, that product prices in particular have gone through the roof. They have soared. And typically, we're looking at indicative prices for jet fuel of about $175 a barrel. The prices have come off just a little bit in the last few days, but they're still very, very elevated. And that is because of the thought that sanctions are going to be introduced and tightened over the next few months, and that is going to lead to a tightening of the market and continued upward price pressure. Now, Russian oil in particular, since the crisis, we've seen or started to see a significant reduction in exports from Russia, which gradually, because of the lack of available storage capacity in Russia, as seen as the system backs up, cutbacks in production. Meanwhile, there have been, even ahead of official sanctions, measures taken by many traders to cut their purchases of Russian oil on moral grounds, amongst other things, and also in anticipation that contracts which expire each month for the purchases of Russian oil, those contracts do expire and the traders and other interested parties do not renew them. So we started to see Russian oil prices fall because of the relative lack of demand. And the chart shows that which I plotted, the normal differential of the Russian Urals crude price against the benchmark Brent. And normally, as you can see on the chart, Urals trades just a few dollars, less than $5 or so a barrel below Brent, representing the different quality of Urals versus Brent. But as soon as the invasion took place and as trading companies started to self-sanction, we saw the price of Urals compared to Brent collapse. And it's trading roughly $30 a barrel below the price of Brent. Now, that's presented for some countries and some buyers an immense opportunity, because leaving aside the moral arguments about the Russian invasion of Ukraine, if you are a significant importer and buyer of crude oil, the opportunity to buy barrels of oil which are compatible with your refining system at a price that is $30 a barrel below the normal level you would pay is pretty irresistible. And we've seen some countries, India in particular, which was not a significant buyer of Russian oil before the crisis, has increased its purchases significantly from normally less than 50,000 barrels a day. And we've seen figures of 200,000 barrels a day and indeed rising. So India has taken advantage of the availability of cheap Russian oil to save money, essentially. Having said that, of course, a $30 a barrel discount from $110 a barrel still means that the Indians are paying prices which were fairly normal in the run-up to the crisis and fairly normal before we started to see the recovery in demand as the lockdown measures were eased. But Russian oil so far has definitely been hit by buyer reluctance. And one other point before I move on from this chart is that according to one website that was shown to me, which attempts to estimate how much money the European Union countries and companies are paying for Russian fossil fuels as a whole, it's thought that since the 24th of February, the date of the invasion, roughly $1 billion a day has been paid by European Union countries for Russian fossil fuels. So there's still a huge transfer of money from the European Union to Russia before sanctions take significant effect. Now, Europe, as we're all coming to realize as we discuss sanctions and their potential impact, Europe is very heavily dependent on Russian fossil fuels. And the chart that I created here takes all of Russian fossil fuels and charts the dependency of key European countries on Russian fossil fuel imports as a percentage of domestic demand. And pretty well all European countries have a very high dependence, as you can see. In the case of Lithuania, it's enormous, nearly getting on for 100%. But for many other countries, of course, Germany being the biggest and most important of them all on this chart, even in the case of Germany, you're looking at a dependence of just short of 40% of total fossil fuel demand is represented by Russian imports. So Europe is heavily dependent on fossil fuels. As I said, some countries it's more acute than others. Hungary relies on Russia for all of its natural gas and about 60% of its oil. Greece takes 91% of its oil from Russia. Slovakia takes over 90% of its gas from Russia. So as the European Union sanctions are being put together and are being tightened up, despite all the issues there are within the European Union over the reluctance of some countries to take part, including Hungary, there is clearly a massive challenge if we are to replace the Russian volumes of fossil fuels that come into the European Union. Now, the other side of the coin, as far as dependence is concerned, is that, of course, Russia is very, very heavily dependent on the European market for its fossil fuel exports. And I've shown the data for gas and oil on this pair of charts. And as you can see, 85% of pipeline gas exports from Russia, and pipeline gas is the overwhelming majority of the Russian gas exports, 85% of it goes to the European market. And as far as oil is concerned, it's just over 50% crude oil and products goes to the European market. And Russia obviously is faced with its own challenge. If the European Union is looking to replace Russian supply, Russia is obviously trying to look to replace European demand. And that is their challenge. And of course, as I suggested a moment ago, they are supplying more oil currently to India. There are indications that they will be supplying more oil and gas to China, because China has obviously a rising demand as it comes out of lockdown, and the Chinese market will be very attractive to Russia. So there is a mutual dependency. Europe needs Russia's supply, or has needed Russia's supply, and Russia has needed Europe's demand. Now, as we go further on into the presentation, I'm just going to look for a moment at this is a very back of the envelope type of chart, but it's intended to show an order of magnitude, so that if in the very short term, i.e. during the next few months, Russian oil supplies were not available to Europe, either because sanctions were very suddenly tightened up more considerably than we currently expect, or the Russians themselves decided to cut off supplies, what is the possibility of replacing feasibly Russian oil exports? And on the left-hand side, we show the potential loss of Russian exports in an extreme case to Europe. And on the right-hand side, using broad numbers, because there are very different estimates for Saudi Arabian production, for example, and one or two other countries, what is the available spare capacity looked on certainly from crude replacing the loss of Russian exports. And a point to make here, which is, I think, extremely important and doesn't get perhaps the coverage in the wider press than perhaps it deserves, is that there is very, very little spare oil production capacity in the world today. In terms of spare capacity, which could be turned on relatively quickly as a political decision, there is only Saudi Arabia, the United Arab Emirates, and essentially that's it, who could increase their production quickly. And in the case of Saudi Arabia and the United Arab Emirates, together, they're sitting on about 3 million barrels a day of spare production capacity. Elsewhere, in the United States, prior to the onset of the pandemic at the end of 2019, United States crude oil production had reached 13 million barrels per day. Now, today, after falling back during the pandemic, US production has recovered to some extent. However, it's still running roughly 500,000 barrels a day or so below its pre-pandemic level. So you could argue that is spare capacity. But of course, the United States does not have an oil ministry. There is no ability in the United States to compel companies to produce more. It's not essentially a nationalized industry. So there is limited ability in the short term to see higher production from a fairly limited number of countries. Looking into 2023 and beyond, there is going to be some more production from the US, undoubtedly. There will be more production from the likes of Brazil and possibly Guyana. But there is a very, very short list of countries which are sitting on spare production capacity for oil. And as we have seen in recent months, members of the OPEC Plus production alliance have not been able to increase their production each month as they have committed to do because of bottlenecks, constraints, lack of investment, various other problems within their industries. And as I said a moment ago, it's only Saudi Arabia and the United Arab Emirates within the OPEC Plus family which has the ability to make any significant change. Now, moving across to gas and specifically LNG. And this is quite important because if Europe is to wean itself off Russian pipeline gas, the majority of the alternative supplies to Europe will come from LNG, liquefied natural gas. And for those of you who are familiar with the LNG market, we've seen in recent decades, the last 15 to 20 years, a huge increase in the availability of LNG into the global marketplace. And in fact, just in 2020, LNG overtook pipeline gas to become just about 51%, I think it was, the majority share of internationally traded gas. So LNG has become very important. And LNG and the flexibility of having LNG moving around on ships has helped create a more flexible natural gas trading system and has helped create, to some extent, the growth of a gas spot market. But it is LNG which is going to be the answer principally to any shortfalls from Russian gas coming in to Europe. And obviously, with the intention to reduce Russian supplies, this is adding additional uncertainty in what was already, before the Russian invasion of Ukraine, a tight market. Europe's been at the center, the epicenter of gas market tensions since the invasion began, but also, of course, Europe, the Northern Hemisphere in general, was obviously still in the middle of the winter heating season when the invasion took place. Luckily for Europe, there were very adequate stocks of natural gas available to deal with the second half of the winter heating season. And we were helped also by relatively mild winter weather here in Europe. So we were able to get through the winter heating season 2021-2022 without any mishap. But Europe, because of the rising demand for LNG supplies we're going to see in the next few months, is essentially becoming a premium market. Europe is competing with buyers in Asia, where Japan, Korea, China, India to some extent are significant buyers of LNG, and they will be competing with European buyers for volumes which will come, as we suggest in the chart. There will be increased volumes from the United States. That has been committed by President Biden very early on in the period after the Russian invasion of Ukraine, and other exporters such as Qatar, Australia, and one or two others will also increase their shipments. So far, lower Russian supplies of gas that we have seen, as contracts have expired or the Russians have decided to cut countries off, have been largely compensated by higher shipments from the United States and the others. But as I say in the footnote to the chart, supplies are being diverted from Asia because high prices or higher prices here in Europe are attracting cargoes from the Asian market. But as we say at the end of the chart, high prices are dampening demand. It's often said that the cure for high prices is high prices. The prices will lead to some degree of demand destruction, and that will help ease the market. But as we move through the summer months here in Europe, the attention will be focused on restocking ahead of the 2022-2023 heating season, and there are already signs that restocking of natural gas stocks here in Europe is going pretty well. The fill rate in natural gas storage has been quite high, so we have optimism that come October, when the heating season starts, we will have achieved a good level of stock, which will hopefully ensure European industry and domestic consumers that they will have enough gas to get them through the winter season. Just a couple of charts, or a chart on the overall LNG situation. As I said a moment ago, LNG shipments are now more than 50% of all gas trade around the world. On the left-hand side of this pair of charts, you can see that who are the big exporters, with Australia, Qatar, United States, of course, the huge growth in the shale gas industry in the US over the last decade, making it a big exporter. Australia, Qatar, and the US have the majority between them. But there's a list of other countries which are not insignificant. Russia itself, and of course Malaysia, Nigeria, Algeria, and others, which are major shippers. On the right-hand side of this pair of charts, we show who are the big importers around the world. And hitherto, that's mainly the Asian economies, with Japan and China, Korea, India being at the head of the queue of imports. But Europe's already, even before the crisis, a big importer of LNG from around the world. And it's been taking significant supplies even in 2020, before the pandemic set in full. It was taking 22% of its supplies from the US, just under 15% from Russia, and then the other figures for the other countries are there for you to see. So it's going to be a big challenge, but hopefully there will be plentiful supplies to come into Europe in the next few months to build up the stocks ahead of the winter season. But on paper, having supply and having demand is one thing, because LNG, of course, has particular characteristics. To create LNG, you require liquefaction facilities. As an exporter, you have to turn natural gas and freeze it and compress it, or cool it, I should say, and compress it so that it can be put onto the ship and transported. But of course, at the other end, you need regasification facilities. You have to take the liquefied gas and turn it back into natural gas form to move through pipelines to the market. And Europe has capacity issues because, of course, European policymakers appear not to have taken into consideration the fact that Russian behavior could be so egregious that they would want to cut off supplies. There are certain countries in Europe which do not have the ability currently to receive LNG cargoes on their own territory, process it, and then ship it to the market. And Germany is one of the most, or probably the most notable example of that situation. There are planned LNG facilities in Germany. Those plans have existed for several years, but now in the face of the crisis, Germany has been actively seeking to buy LNG from Qatar and from other countries, and to bring that LNG initially would probably have to come to Poland or elsewhere in Europe, and then compete for space on pipeline networks to get the gas into the network to support German businesses and German domestic consumers. So there is a mismatch between the current configuration of LNG plants in Europe. As you may be able to see on the chart, there are plentiful LNG facilities, for example, in Spain and in Portugal. But the ability for more LNG cargoes to come to Spain, to be regasified, and then transmitted through the pipeline network into Europe, that is very, very difficult, because pipeline networks out of Spain into France and then further into continental Europe, those pipeline networks do not exist, or where they do exist, there is insufficient capacity. So there are huge capacity issues and logistics issues which the European policymakers and working with the companies are going to have to solve in the next few months. Well, indeed, it will take longer than a few months, but they're going to have to work actively on these issues if they really are to build in medium and long-term security resilience against the loss of Russian supplies. So it takes a long time to build facilities. One option that is being considered is the use of floating LNG facilities, and there is some spare capacity in that sector. Floating facilities cost, depending on the size of the facility, something up to about $500,000 per day to charter. And Germany, for example, is certainly looking at that market and looking at the availability of any spare floating regasification facilities that may be available to help ease their situation. What I'm going to do in the next few minutes is just focus, in the final few minutes, is just focus on a particular issue which I think is extremely important. And this point transitions to some extent into the debate we're having vis-a-vis the ongoing use of fossil fuels versus the needs of the energy transition, that is to transition away from fossil fuels into cleaner, greener, low carbon energy sources to meet the requirements of the COP26 agreement and the requirements of economies to continue to operate and have the availability of plentiful clean energy that I describe as the investment shortfall. And as I said, I used to work at the International Energy Agency here in Paris, and one of the pieces of work that my team had input into was a piece of work updated every year on energy investment. And in the period 2010 to 2014, which is shown on the left-hand side, right at the left-hand side of both of the charts on this slide, in 2010 to 2014, it's crucial to point out that oil prices for Brent crude oil averaged roughly $100 a barrel throughout the whole period. Brent's about $110 a barrel today. Through the whole of that period, $100 a barrel. That meant investment was high because it was attractive to do so. And as is always the case, if you're living in a world of $100 plus for several years, you think it will never end. So there was lots of investment. In the period following the crash of oil prices, which started at the end of 2014 and went all the way through to the beginning of 2016, investment fell back. And it fell back, of course, dramatically also in 2020 as the pandemic set in, oil demand collapsed, and companies reined in their plans. Now, in 2021, the numbers we've currently got, and these will be updated probably quite soon, we have seen a modest uptick in investment. But the problem that we have is that the investment that is taking place, particularly in the oil industry, is taking place primarily to maintain current levels of production. Decline rates in the oil fields average, again, estimates vary here, but some natural decline, something like 5% a year. It can be higher in some parts of the world. And you have to invest continually to maintain your current levels of production before you think about investing even more, if you wish to do so, to expand production capacity. So we've seen a lot of the investment directed towards brownfield, if you like, that is the maintenance of current production. So the investment picture is tricky, and it's the same to some extent for natural gas. Again, because of the collapse in prices or the fallback in prices in the middle part of the last decade, and of course the problems presented by the pandemic, investment in the natural gas upstream sector has not increased sharply in recent years and presents bottlenecks for the future. Now, the reason that I think this is very important is in this next chart, which just looks at oil demand for the time being, just to make the point, because it is my belief that following the collapse of demand we saw in 2020, when demand fell essentially from 100 million barrels a day to 90 million barrels a day, oil demand is recovering, and it recovered pretty strongly in 2021 as the lockdown measures around the world were eased. It's continuing to recover here in 2022, although at a slightly slower pace because of the new Chinese lockdowns we've seen. But the point is this, is that as we move through the rest of this decade, demand is going to grow, and it will grow because, as I say in the chart here, as you can see, the driving forces behind oil demand growth remain very strong. In transport, although there are big percentage increases in sales of electric vehicles, the fleet remains overwhelmingly dependent on internal combustion engines. Trucking is a sector which will remain overwhelmingly dependent on fossil fuels, internal combustion engines for the foreseeable future. The same applies to the aviation industry. The same applies to the shipping industry. Electrification in those sectors on a mass scale is still a very, very way. And there are large parts of the world, developing Asia, for example, Africa is another example, where incomes are rising amongst the population. They're starting to get wealthier. People's aspirations are growing. They're moving away from 2 wheels to 4 wheels. They're starting to fly. And crucially, the last sector, which I didn't mention, is petrochemicals. As people get wealthier, they buy more things. They're consumers. They buy stuff, and stuff means plastics. And plastics is a huge sector of the economy, representing the growth of demand for consumer goods. And for the time being, that is going to remain overwhelmingly dependent on the traditional fossil fuels. So there is huge dependence. And my personal feeling is that oil demand in particular, and this applies to natural gas also because of the growth of the use of natural gas in the power generation sector, as hopefully coal use declines, that demand, oil and gas, is going to grow considerably over the next decade. And the investment, I believe, has not been sufficient to make up for that expected demand. And the investment is insufficient, partly because of lower prices, but also because of ESG pressures, which are being brought to bear by some financial institutions against the traditional fossil fuel companies. So potentially we are storing up trouble for the years to come. And we're now starting to see a debate between those who are passionately committed to decarbonizing the energy sector as fast as possible, and those who perhaps we could describe, or I will use my own word, realists, who recognize that there is a big issue of the here and now today to ensure that adequate supplies of fossil fuels are available at fair prices to the people who need them. So a little segue at the end there away from the immediate situation affecting Europe, but this investment issue is something that I certainly feel very strongly about, and I take every opportunity to talk about this when I can. Finally, just one or two takeaways. It seems pretty obvious to us all that the Russia-Ukraine crisis is here to stay. The only way in which it's reasonable to see any kind of change would be if there was a change at the head of the Russian government. Because if that were to be the case, for whatever reason, it is possible that a more sensible government would seek to find some kind of way out of the Ukrainian problem. And therefore, we may well be back in a situation where it is expedient, certainly an awful lot easier for the European energy sector to revert to using Russian supplies. Who knows? That's a possibility. As I said, we've had price pressures even before the invasion, not just in energy, which we're focusing on today, but we're seeing prices in agricultural products, minerals, various other sectors. We're looking at the spectre perhaps of stagflation with lower economic growth, but sharply higher price levels. Obviously, Europe most affected by the invasion because it's on Russia's doorstep, but the ripples from the Russian invasion do reach other markets because, as I suggested a moment ago, Asian buyers will be competing with European buyers for LNG cargoes and for oil supplies from other places. Replacing the Russian oil is not easy. Reading the news flow today, Hungary is becoming more strident in its objections to the European Union sanctions against Russia, which, given Hungary's dependence, is unsurprising. So it's not easy. It's a major task. And longer term, piled on top of the disruption caused by the Russian invasion of Ukraine, and piled on top of the issues we're seeing from the wider impact of inflation, the upstream investment shortfall, which has been flagged up for several years by many analysts, that is possibly coming back to bite us, and bite us pretty hard. I'll stop at that point. Thank you very much indeed for your attention. And if anybody does have any questions or observations, I'd be delighted to address them. Thank you.
Thank you, Neil. If you may, I will ask the first questions. And getting back to spare capacities and what shale oil and I would say shale type used to be in the past as a swing factor in terms of marginal supply in the world. Don't you think that could happen again? Because in March, we hit a kind of high record in permits granted in the Permian. So how do you see that? How long does it take to get the permit and then to go to production, and how that could impact the demand and supply situation in the oil market?
Well, large numbers of permits being issued is, you could say, is a healthy sign, but it's not that abnormal. Obviously, it's a high level because we've come out of the pandemic, but companies have been stocking up permits for some years, and they, for various reasons, don't, having received a permit, initially start drilling and producing. The problems with the US shale sector at the moment are not so much because there's a lack of permits, There is the pressure from investors in the US shale sector who, despite all appearances to the contrary, with production having gone up, US oil crude production having gone up from 5 million barrels a day in 2008 to 13 million barrels a day at the end of 2019, investors have not made a lot of money. And now that the industry is regrouping following the pandemic, investors are demanding tighter capital discipline, and they're also demanding returns. So they want more of their money back. They want to see a return on their investment. And that is one of the reasons why US supply is not returning quickly to the levels that it was before the pandemic, even though prices are obviously well over $100 a barrel. And there is another very important point which should be stressed, is the very tight market in the United States for labor, the very tight market for equipment and materials to use in the shale sector. A lot of people, a lot of individuals left the sector in 2020 when production fell back very sharply. There are constraints in lack of availability of equipment, spare parts, valves, tubes, pipes, you name it. And those constraints are quite important. And as I said before, labor. There is a shortage of crews available to work in the shale patch, which is why the recovery has been slower than some people have expected. And indeed, the US government, having initially, after the Russian invasion, started asking Saudi Arabia and other countries for more oil, sent a delegation to Venezuela to investigate the possibility of oil from there, talked with Iran under the umbrella of the nuclear talks about the possibility of more exports from Iran, finally got round to asking its own producers to produce more oil. But as I said, production has recovered to some extent, and it will go up again later in 22 and 23, but it will not be going up sharply for the reasons that I said.
Okay. We've got a question from the audience. The question is, why Germany put all its eggs in the same Russian basket?
Well, that's a good question. And of course, that's the answer to that is partly, or indeed, I suspect, overwhelmingly political. Going back, of course, many decades, the relationship between Germany and the Soviet Union was a delicate one and a very important one. And as part of the Ostpolitik drive by Willy Brandt and other German figures, cooperation between Germany and the Soviet Union was pretty strong. During the Soviet period, despite all the tensions over where were we, Hungary in 56 and Prague in 68 and other disruptions that took place, or other periods of geopolitical tension, supplies of oil and gas from the Soviet Union to Europe and indeed elsewhere were very rarely interrupted. It's only in recent times, since Putin came to power and started to play games, if that's a way of describing it, with Ukraine, have we seen any significant disruption. And this is before the current crisis. A few years ago, there were disputes between Russia and Ukraine over payment terms. Ukraine is an important transit route for Russian supplies to reach Western Europe. So Germany, I guess, has built on a long-term policy of a rapprochement, if that's the right word, with the Soviet Union and then Germany, and a feeling that relations would always be sound enough that there was no significant risk. And that was a political calculation that was made. As I said a few moments ago when I showed the map, Germany has not built any LNG import terminals. There are something like 30 around Europe, dotted around Europe, including all the way from Portugal around to Turkey and the UK and France and the Benelux, not Luxembourg, but Belgium and Netherlands. A lot of people have LNG terminals. Germany never bothered because it had Russia as a reliable supplier, and it's now, I think, as the question implies, reaping what it has sowed in terms of relying not exclusively but overwhelmingly on Russian supplies. And it's turned out to be a big geopolitical error in the Putin era. because nobody expected Putin to behave in the way that that he has. So Germany's in a very, very tough situation, and this Germany will be interesting because with the overwhelming reliance that it has on Russian fossil fuels, vis-a-vis the continued need of industry to operate without interruption, the continued need to supply gas and oil products to the German heating market, the resolve of the German government to move away from Russian supplies, which it at the moment seems to say it's going to do, that resolve may well be tested. So the unity of the European Union, which we've seen pretty well so far, despite the tensions with Hungary, that unity could be tested. But that's a great question, and Germany has put itself in a very, very awkward spot.
Okay, to follow up on Jack's question, and this is the $1 million question on energy transition, because Germany and other countries in Europe will have to invest in new infrastructure for LNG. So what would be your estimate in terms of total investment required? That's the first question. And the other question is the trade-off between fossil and LNG, and in terms of energy transition, because if we invest that amount, you're going to tell us you're not invest in energy transition. That's the first trade-off. And the second trade-off is what gas is cleaner, US, Qatar, Russian, including transportation, because there are debates around that point, because
the carbon intensity.
There's a kind of double whammy, reducing a relationship with Russia, but investing in fossil, but within fossils, probably investing in cleaner LNG products from Qatar or the US. I don't know the answer, but please tell us.
Well, no, and the question is worth a lot more than $1 million, I'm afraid, and that this is a huge, almost existential question.
I send the bill to the audience.
Well, I think so. Yeah, I'm sure they'll happily pay. The problem we've got is that we have a crisis which has been brought upon by Russia at the same time as just a few months ago we had the COP26 summit in Glasgow, where the signatories re-emphasized their commitment to decarbonizing the energy system. And we are now learning that if, as we believe is the case, Russia is going to be excommunicated from global markets for some time to come. It is not possible to replace Russian fossil fuels with clean energy in the short term, as I said, because of the captive market that oil has still in transport, in land, sea, and air, and in petrochemicals. And of course, even before the Russian invasion, to talk about cleaner fossil fuels, there were debates about how we move away from burning coal in countries such as Germany. Poland is another very, very important coal market in Europe, employs tens of thousands of coal miners, as is still, of course, the case in Germany. And there is the debate about how you move away from using coal and re-gearing your energy system to using wind and solar and natural gas, which is obviously a cleaner burning fossil fuel, seen as a transition fuel, a bridge fuel towards an overwhelmingly clean generation system. And that debate has been thrown into sharper focus because we have a here and now crisis which cannot be solved by low carbon energy. And of course, if we are to invest, as you suggested, in more LNG import facilities, which the Germans are clearly now doing, or actually developing plans which had sat there for a long time. Whether you thought they ever really intended to do them is another matter, but now they are going to have to spend tens of billions of dollars on investments which are on projects which have a 20 or maybe 25-year life. Now we're looking at a situation where we're in 2022, and the countries which are signatories to the COP26 and other climate change agreements, the policy objectives of the European Union, well within a 20 to 25 year time frame lifespan of an LNG project, we are supposedly significantly reducing our reliance on LNG and coal and other sources for the power sector, because we're going to be using more renewables, wind and solar. Let's not even get into nuclear. That's another huge story. So who is going to fund these investments which may be stranded? Who is going to fund these investments in potentially stranded assets? Government? Well, governments are strapped for cash. The private sector? Well, why would they invest tens of billions in potential stranded assets without some kind of guarantee from the government that they will be guaranteed some kind of acceptable return if they start to develop LNG facilities now? And that's a huge policy question, which Brussels, the European Union, and the individual governments in Europe are going to have to grapple with, because you can't have, it's a situation of, yes, we should be transitioning to low carbon energy. I get that. I support that as a citizen. But the here and now, the environment in the here and now, the circumstances in the here and now have changed radically. And they are going to have to accept that this has changed, and that fossil fuels will be, and the change of the structure of the use of fossil fuels is an issue that's facing us now and is here to stay. And yes, you can look at the full carbon impact of the production of fossil fuels. In the case of LNG, the gas is piped to a plant, it's liquefied, put on a ship, sent to a plant, regasified, sent through a pipeline to a market. The carbon budget, if you like, of that process is significant. We all know what damage coal does. We just have to accept that we are going to have to make these investments to maintain security of supply, but do everything we can to make it as clean as possible. That implies the deployment of the most advanced technology, but that costs money. And I don't see how government, well, it won't happen unless there is some kind of government policy which makes investments attractive to the private sector.
Neil, thank you so much. If there is no other questions from the audience, I suggest we stop now. Thanks for these fascinating issues you raised and the good answers to the questions asked from the audience. Thank you so much, Neil, and I wish you all a very good day. Thanks.
Thank you.